NIO stock investors are getting excited about the company's future as it recently launched the new Envo brand that is selling quite well, competing with Tesla's Model Y with the specific model, the Envo L60, which is selling quite nicely in its home market. So investors are asking me again if I think NIO stock is a buy right now. If you remember, coming into 2025 and for several years that I've been following NIO stock, I've been telling investors not to buy it, that the company was still too early in its development. It was losing too much money. And I told investors it was not a buy. And hopefully you heeded that recommendation and you saved yourself a lot of money because NIO stock is down over, depending on the time period you look at, it's down significantly from its high watermarks. So at this lower valuation, is the stock a buy? I'll answer that question. I'll look at a couple of valuation metrics in addition to the company's performance. I'll look at and I'll share with you my proprietary discounted cash flow model, which shows you how much the fair value of NIO stock is. And I'll also look at NIO on a forward price to sales basis to determine if the valuation is appropriate for long-term investors. So let's jump in.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, looking at revenue growth, it's been volatile for NIO. It's been up and down. The company has launched several new models and several new initiatives over these last several years, and revenue growth goes up and it goes down. In the most recent quarter was 13.25% revenue growth. In January of 2025, NIO reported delivering 13,863 vehicles, and that was a 38% increase from the same month the prior year. So if that trend continued for the rest of its first quarter for 2025, the company is going to report a very healthy growth number in the first quarter of 2025. Remember, I've been saying that China is the only market, one of the only bigger markets in the world that's adopting electric vehicles at a accelerating rate. So at a healthy rate, people in China are buying electric vehicles. The last report I saw was that 1 out of every 3 car sales was a new energy car sale, which is non-internal combustion engine. In the US, less than 1 out of 10 car sales are electric vehicle sales, and the market is growing not very strongly. But in China, the people in China, the market really likes electric vehicles. And NIO has an interesting model for selling electric vehicles. They have that battery swap technology where you don't have to wait for your battery to get charged. You can instead swap the battery. You can also have battery as a service with NIO. And so you don't own the battery, but you're renting the battery. So they have some unique approaches to the electric vehicle market. And they've announced that newer brand, Envo, as I mentioned, which is a lower priced brand. Their NIO brand is a higher priced, more premium model. The Envo brand is a lower priced, and they're also going to come out with another lower priced brand called Firefly. And so they're right now reaching a broader market, and their sales are likely to accelerate going forward. The bad part about NIO's business is the profitability. They keep losing more and more money on the bottom line. All of these investments, new brands, new models, more charging stations, all of that is costing the company significant sums of money. And in the most recent trailing 12-month period, they lost $3.157 billion net income loss. And the trouble is that the more they grow, the more they're losing money. You've heard me often say, I don't mind investing in companies that are losing money on the bottom line, as long as they're showing me improvement, progress towards profitability. I'm not seeing the progress towards profitability with NIO in terms of the bottom line numbers. However, I am seeing progress for NIO in terms of the vehicle margin, the specific profit margin on each vehicle sold. In the fourth quarter of 2024, NIO reported a vehicle margin of 13.1%, which was an improvement from 11.9% in the same quarter last year. And for all of 2024, they reported a margin of 12.3%, and that was up from 9.5% in 2023. So in terms of vehicle-specific margins, they are improving, but overall company-wide, I'm not seeing the level of improvement I would like to see from a company that's losing so much money on the bottom line. And so the returns on investor capital, as you might imagine, have stagnated and are getting worse, 52% negative, and that's been trending lower since 2022. So they are generating this increase in sales, the increase in margins in the vehicle, but it's costing a lot of capital investment for the company to achieve these margins. They're having to spend a lot of money to achieve this level of growth and this level of improvement. So now let's look at valuation. Right now, when measuring on a forward price to sales basis, NIO stock has never been cheaper. It's trading at a forward price to sales of just 0.5, and that's the lowest it's been going back at least 1 year, and I can zoom out longer than that. If I zoom out 3 years, you can see the valuation is down considerably. That's why I mentioned in the beginning of the video, hopefully you haven't been caught up in this stock and have lost a lot of money on this stock because it's down big time from the elevated levels in 2021 and 2022, when, of course, nearly every electric vehicle stock was on fire and soaring to levels that they should not have reached, in my opinion. So looking at the forward price to sales, the stock looks undervalued. And then looking at my discounted cash flow model, I'm forecasting that the company turns cash flow positive in 2027 and generates $1 billion in free cash flow. And that number increases to $3 billion by 2034. The intrinsic value per share I calculated for NIO is $6.37. The current market price is $3.98. So according to my discounted cash flow model, NIO stock looks undervalued. All that being said, this is a very above average risk business. The company's still losing money on the bottom line. It's expected to lose money for all of this year and all of next year as well. So these losses are substantial, and there is no telling if it will turn things around and generate these positive cash flows. But it's getting better and it's getting closer. To answer the question, finally, is the stock a buy at current valuations? I'm going to say not yet, but it's almost there. And so I'm keeping this stock rated as a hold, and I'm updating that today, March 27th, 2025. But I wouldn't be surprised if in the next few months I upgrade this stock. Out of all of the electric vehicle stocks that I'm following, NIO stock is the one that looks closest to being upgraded to a buy in terms of the undervaluation. The stock value has gotten so depressed, and the company's expansion is now into the lower priced models, and it's ramping up deliveries. The vehicle margins are increasing, and it's operating in the most attractive electric vehicle market in China, right? If the electric vehicle industry is an unattractive industry overall, but if you're going to be in the electric vehicle business, it's best to be in the electric vehicle business in China because consumers in that region are actually buying electric vehicles in large numbers. They actually like them in that region. And so that's why I say it's one of the closest ones to being upgraded to a buy. But I'm not quite comfortable yet upgrading this stock because I want to see more improvement in the bottom line, in free cash flow, in the returns on investor capital, and more progress on these lower priced brands before I make that upgrade to a buy. Hey everyone, I'm excited to announce a brand new private Discord for our channel members at the VIP Discord level. It's a great place to connect with me directly, engage with like-minded investors, and learn more and take your investing to the next level. Spots are limited, so join now before it's too late.